Markets are swinging wildly, inflation refuses to go quietly, and every headline seems to scream crisis. But here's the secret. Economic uncertainty isn't the enemy, it's your edge, if you know how to play it. In this video, I'll show you how smart investors are navigating 2025's chaos and positioning themselves not just to survive, but to grow their wealth when others are pulling back. Hey, I'm Robert, and this is The Alternative Investor. In this video, we're tackling one of the biggest challenges of our time: how to invest when nothing feels stable. Interest rates are shifting, consumer sentiment is weakening, and geopolitical tensions are shaking the markets. But you don't need to sit on the sidelines or panic sell everything. Today, I'll walk you through a battle-tested strategy that includes asset allocation, income generation, risk management, and even emotional discipline, so you can stay in control, no matter how wild the market gets. Before you invest wisely, you need to understand what you're investing into. Right now, the US economy is teetering between slow growth and stagflation. Interest rates remain elevated, but inflation hasn't fully retreated. Real wages are flat, consumer spending is tightening, and corporate earnings are coming in mixed. We've entered what many call a growth scare period. On top of that, the Federal Reserve is in a tough spot, trying to decide whether to hold rates or start cutting them without triggering another inflationary surge. Ongoing trade disputes and tariffs, especially targeting Chinese imports, are straining corporate margins and global supply chains. Lenders have tightened credit standards, making it harder for small businesses and consumers to borrow, which slows down spending and hiring. This combination of tight monetary policy, fiscal uncertainty, and market volatility makes 2025 one of the trickiest investment environments we've seen in years. In times of uncertainty, investors need to shift focus from rapid growth to capital preservation and reliable returns. Start with consumer staples. Companies that provide everyday essentials like food, cleaning products, and hygiene items. These are things people continue to buy regardless of economic conditions, making the businesses that sell them stable and defensive. Next, consider utilities, which deliver electricity, gas, and water. These services are non-discretionary, which means people and businesses continue to pay for them, even when times are tough. That results in stable revenue and often dependable dividends. Healthcare is another resilient sector. People don't stop filling prescriptions or going to the doctor because of a slowdown. This gives healthcare providers, pharmaceutical companies, and insurers a durable edge during recessions. Lastly, don't underestimate the power of gold and precious metals. When the market gets rattled or the dollar weakens, gold often rises as a safe haven asset. It's not about speculation, it's about balance and protection. In unstable markets, diversification becomes non-negotiable, but true diversification goes far beyond just owning a few different stocks. You want to diversify across asset classes, not just stocks and bonds but also real estate, commodities, and even private investments. That way, if one market dips, the others can help stabilize your portfolio. You should also spread your equity investments across different sectors. For example, combine exposure to technology, healthcare, energy, and industrials. If tech underperforms, energy or staples might hold up better. Don't forget about geographic diversification either. The US market doesn't always outperform. Investing in emerging markets, Europe, or commodity-driven economies can give you exposure to global growth and currency variation. Finally, diversification means thinking about income sources. That could include rental income, dividends, royalties, or interest from bonds or savings products. Building multiple streams of passive income provides resilience when one stream slows down. Even holding cash is part of smart diversification. Cash gives you flexibility, a cushion in downturns, and the ability to buy assets at lower prices when others are panicking. When inflation is high or markets are volatile, real assets often become more attractive than paper ones. Real estate, particularly rental properties, provides income through rent and can increase in value over time. Inflation can actually help landlords, as it allows them to raise rents while their mortgage stays the same. Commodities like oil, copper, and agricultural products are tied directly to global supply and demand. When prices rise due to shortages or conflict, these assets often surge. They're not just inflation hedges, they're real economic levers. Infrastructure investments, such as toll roads, bridges, data centers, and renewable energy facilities, offer long-term, contracted cash flows. These projects often have government backing and are increasingly accessible via ETFs and investment funds. Real assets tend to be less correlated with the broader stock market, which means they can smooth out your returns and help protect your portfolio in downturns. Volatility can feel scary, but it's also a gift for the well-prepared investor. When markets are choppy, options premiums go up. That creates opportunities to generate income by selling options, particularly if you already own or want to own a stock like Tesla, Apple, or a dividend ETF. If you already hold shares, consider selling covered calls. This means you agree to sell your stock at a specific price and get paid a premium up front. If the stock stays below the strike, you keep your shares and the cash. If you're not yet in a position but want to be, you can sell cash-secured puts. This means you get paid for agreeing to buy a stock at a lower price. If the stock doesn't fall to that level, you still keep the premium. These strategies aren't about gambling, they're about creating consistent calculated cash flow from market chaos. This might be the most important chapter of all, because even the best strategy can fall apart without emotional discipline. Fear and greed are the twin killers of long-term success. Most people panic sell during downturns and FOMO into rallies at the top. That's why so many underperform their own investments. The solution: develop a long-term framework. Set clear goals for your portfolio. Know why you're investing and what timeline you're working with. Automate your contributions so you're dollar-cost averaging regardless of the headlines. Tune out the noise. Watching financial media all day won't help you. It'll stress you out and cloud your judgment. And finally, keep a journal or checklist to remind yourself how you respond during market stress. The more aware you are of your emotional triggers, the easier they are to manage. Remember, the greatest investors in history didn't succeed because they predicted the future. They succeeded because they kept their cool when everyone else was losing theirs. Here's the truth: you don't need to know what's coming next, you just need a plan for whatever comes next. In 2025, investing wisely means being diversified, emotionally grounded, and ready to act when others freeze. It means building income streams, hedging risk, and viewing volatility as opportunity, not danger. If this video helped you feel more confident, hit that like button and subscribe for more. Also, let me know in the comments, what's your #1 strategy right now for investing in uncertainty? I'm Robert, and this is The Alternative Investor.